As the Federal Reserve continues to raise interest rates, the price of borrowing and taking out loans has gone off the charts. Whether you're trying to take out a student loan to further your education, get a car loan so you can have reliable transportation, or finally pursue that American dream of getting your first home loan, the cost of borrowing is absolutely off the charts. But what if you're on the flip side of the equation? What if you've got a little extra cash in your pocket that you're trying to turn into, well, a little more extra cash in your pocket? You might be wanting to take advantage of the higher interest rates in the economy, but you have no idea where to start. Your friends may be telling you that you need to get a CD, a money market, a high yield savings account, or even invest in Treasury bonds. How do you keep all of these different products straight, and what are some of the important things to think about? We're talking all about it in today's video. Hey everyone, and welcome back. This is the Part-Time Economist, and in today's video, we are talking about different types of financial products that are designed to help you profit from the higher interest rates in the economy. So, an exciting video, but the most important thing that I want to say right off the start, as with all of my videos, this is not financial advice. I'm not telling you what to do with your money, what not to do. I am not a financial advisor, and I am definitely not your financial advisor. So please do not make any kind of investing decisions based on what I say in today's video. Also, I will be sharing screenshots of real companies offering real financial products. I am doing this to give you an example of some of the theoretical concepts. Just because I show a screenshot from a company does not mean I am endorsing them. It doesn't mean I'm telling you to not use them, right? So please just take the video for what it is, which is simply education. With that being said, let's talk all about interest rates and some of the different types of financial products that are designed to help you capitalize on these higher interest rates and earn a little bit of extra money. Before we get started, there's really two important things to keep in mind when we're talking about these interest rate plays. The first thing is that there's always going to be a little bit of a trade-off between how high of an interest rate you are going to receive and the access that you have to your money. We're going to call that liquidity. So there's always this balancing act between I'm getting a higher interest rate, but I can't withdraw my money for 18 months versus I'm getting a lower interest rate, but I can do whatever I want with my money at any time. The second thing that we want to keep in mind when we're talking about any kind of these products that are designed to help you profit from interest rates, many of these are going to be relatively, and I say relatively in quotes because there's always risks with investing, but many of these are going to be relatively safer investments that have some kind of government protection like FDIC insurance, or maybe in the case of Treasury bills, they're backed by the government itself. But these are not the penny stocks, right? These are not the type of investments that you're hoping to turn into a quadrillionaire overnight. These are, again, relatively safer investments that are designed to help you earn a little extra income, right? Not turn you rich overnight. So with that being said, I want to start off with the most popular types of interest rate products, and the first one of those is going to be the high yield savings account. Now, the high yield savings account is really popular with a lot of people for a lot of really good reasons. Number one, high yield. So if you look at this example from Ally, we're getting a 4.25% interest rate, which is considerably higher than what we would get with a traditional checking account. So we've got high yield, we've got savings account. So that means two things for us. The first, we get FDIC protection, right? So we're not investing in some penny stock that can go to zero. We have the FDIC, we have the federal government saying that our money is safe, which again fits in line with what I was telling you about these investments being relatively safer. So we have a higher interest rate, we've got the government backing us up, and then on top of that, it is a savings account. So people are used to working with their checking account, their savings account. So to move from a traditional checking account to a high yield savings account isn't a huge paradigm shift. A lot of people are able to comfortably make that switch. So a lot of good things going for us with the high yield savings account, but it is not for everyone for a couple different reasons. Number one, remember when I was telling you about that trade-off between high interest rates and liquidity, aka access to our money? With a high yield savings account, we do get a much higher interest rate than a checking account. However, because the bank is paying us this higher interest rate, they've got to lend our money out. They've got to make money off our money, which means it needs to be in our account. So you will sometimes see that these institutions with the high yield savings accounts will limit the number of withdrawals that you can make in a certain time period. With the example of Ally, you get 6 per month. So if you do 5, no problem. If you do 6, no problem. On that 7th one, they can hit you with a $10 fee, which isn't the end of the world, but if you're putting your money in a high yield savings account to make more money, that $10 fee can wipe out months worth of additional interest depending on how much you have in the account. So keep in mind, there's that trade-off. If you're doing a lot of transactions, money coming in, money coming out, maybe the high yield savings account isn't for you because it is a savings account. Secondly, and this is just based on my personal experience, but most of the high yield savings accounts that I am familiar with are offered by online institutions, online banks, which makes sense to me because they don't have these huge buildings they've got to pay rent on. They probably have less employees, so they can pass those interest rates on to us as customers. That doesn't mean that there aren't physical banks that have high yield savings accounts. I'm sure there are, but most of the time, at least for me, I've seen them in the online format, and many people don't want to fool with online banking. A second option that is very accessible for a lot of people, perhaps even more so than a high yield savings account, is a CD or a certificate of deposit. And when I think of the vast majority of people that aren't super into finance, but they're just looking to earn a little extra money, I think of high yield savings accounts and I think of CDs because they're the most accessible, they're the most easy to understand, the most straightforward. So with a certificate of deposit, even if you don't want to do online banking, you just want to work with a traditional bank. Almost all banks that I've ever heard of offer some kind of a certificate of deposit. And the idea, the beauty behind a CD is how simple it is. You take X amount of money, you lock it up for a certain amount of time, and they pay you a guaranteed interest rate. So it gives people that security, that certainty, and on top of that, just like the high yield savings account, it is insured by the FDIC. So you have that government backing, you have that support. So to look at a real world example, we can see this example from Ally gives us a 5% interest rate if we lock our money up for 18 months. Now, here's a couple things to be aware of with these certificates of deposits. In its standard format, you're not really supposed to pull your money out early. You can get hit with some pretty hefty penalties if you do so, because again, there's that trade-off because the bank, they're paying you a higher interest rate. They've got to do stuff with that money. They've got to lend it out. They've got to make money on your money. And if you come in to pull that money out halfway through the CD, what are they going to do? Are they going to call back their loans? Right? It causes a lot of problems for them. So you're not supposed to touch your money for that given time period, which means you do get a higher interest rate than the high yield savings account, but we don't get those 6 withdrawals per month that we get with the high yield savings account. So that is one thing to keep in mind. You're not really supposed to pull your money out. The second, and this can be either a benefit or a curse, is that your interest rate is typically fixed. So let's suppose I get this CD with Ally, 5%, and then tomorrow the government does a massive stimulus, the Federal Reserve lowers the interest rates, I am still getting my 5%, which is pretty awesome. On the flip side, if the interest rate in the economy goes up to 7, 8, 9%, I am still stuck at my 5% interest rate. And like I said, that can be a benefit or a curse, which, if we're thinking back to the high yield savings account, that interest rate is going to move up or down with the economy. If the interest rate goes up, Ally more than likely is going to raise their interest rate so I don't take my money elsewhere. On the flip side, and I'm speaking from firsthand experience here, if the interest rate goes lower, the interest rate on your high yield savings account is going to start dipping down as well. I remember I opened a high yield savings account pre-pandemic, and then when the government started lowering the interest rates, it was like every statement I would see, your interest rate has decreased, your interest rate has decreased, and it just kept going down. So keep in mind, CDs do give you a little bit more certainty, but your interest rate isn't going to fluctuate up or down. Now, if you do want a little bit more flexibility, there's different types of CDs that can accommodate that. So you have a no penalty CD where you can pull your money out early without penalty, but again, that trade-off, you can't get away from that trade-off. You're getting more flexibility, right? You can pull your money out at any time, but you're getting a lower interest rate. In this example, 4.5% versus 5% for the traditional certificate of deposit. They've got the Raise Your Rate CD, which starts off lower, but you can raise the rate. That offers you protection in case interest rates go up to 20% or something like that. So there's a lot of different options out there, and each company is going to give you different rates altogether. So this is just a general explanation. When you think of a CD, the key thing to keep in your mind is I'm locking my money up for a certain period for a guaranteed interest rate. Are there variations in different flavors of that? Sure, but that's the general idea behind a certificate of deposit. Moving on to the next example, we have Treasury bills, notes, and bonds. And again, these are backed by the full faith and credit of the United States government, so a very safe investment. So with Treasuries, the basic idea is you buy a Treasury bond or a note or a bill, whatever you want to call it. They have different time lengths. And let's suppose you buy a $5,000 Treasury bond that is for 5 years. Every 6 months, the government is going to pay you your interest. And then at the end of that time period, you're going to get the full principal back. So you give them the $5,000. Every 6 months, you get, I don't know, let's say $100, $50, depending on the interest rate. And then at the end of that time period, you get your initial investment back. So with the Treasury bonds, again, they're backed by the full faith and credit of the U.S. government. You get that periodic interest payment, and then you get your money back at the end. There is a certain type of Treasury bond known as a zero coupon bond that does not pay you interest. But what you do is you buy it at less than its face value. So let's suppose that the face value is $1,000. When you go to buy that, you're only going to pay, and again, I'm making up numbers here. Let's suppose you only pay $900, right? Your interest is that $100 difference. So you buy something at $900, you hold on to it for a year or two, and then you get $1,000 at the end, right? So when we think of Treasury bonds and zero coupon Treasury bonds, there is a little bit of a difference there, whether we're wanting that periodic interest or we just want everything to be accumulated at the end. But again, the key thing here with the Treasuries is that they're issued by the government, they're backed by the government, they do give us exposure to that interest rate. Just as with the CDs, our interest rate is locked in. So if the interest rate goes up and we got a Treasury bond that's at 5%, well, we're still only getting 5%. If the interest rate goes down, good news, we're still getting 5%. And Treasury bonds, you can sell them, you can transfer them. I don't want to get into too much of that here because that's more of a trading strategy. And I'm looking at it just from the perspective of interest rates. So with the Treasury bonds, let's just assume you're buying them and you're holding them, right? You're not trying to sell them or anything like that. You're just going to buy them, you're going to get your interest, and you're going to move on from there. Now, the last type of financial product that we're going to talk about today, and I will be honest with you all, I almost didn't want to include this in the video, not because it's bad, but just because it's so different than the other products we talked about, is a money market fund. Now, when I think of someone that's just trying to earn a little bit extra money, it's easy for me to tell them, hey, a high yield savings account is like a bank that pays you more money. Hey, a CD is like a loan to your bank where you give them the money for a certain time period and they pay you a certain interest rate. Hey, a Treasury bill is basically a loan to the government and the government pays you money, right? Those things are all simple to understand. They're intuitive and I can do most of them through my normal bank. With a money market fund, it's a little bit more complicated, and that's kind of why I didn't want to include it, but I know people probably hear about money markets at the same time they're hearing about CDs or high yield savings accounts, so that's why I'm going to give you a very brief overview. A money market fund is where you will give your money to some kind of company. Maybe it's Schwab, maybe it's Vanguard, maybe your bank has their own money market fund. What that fund manager will do is they will go out there and they will buy other financial assets. So you can see here with this Schwab money market fund, again, just an example, not a recommendation. I know I have to keep saying it. They are invested in tons of different financial products. And again, that's why it's more complicated for me to explain. They're invested in a lot of different financial products. However, you'll notice that they are relatively safe products, such as government repurchase agreements. Again, the goal with a money market fund is to keep the value of the money market at $1 and give you a little bit of an interest rate. And you're probably thinking, gee, that sounds really complicated. Why would I go with this money market fund if I could just do a CD or a high yield savings account or even a Treasury bond, right? Money market funds can be used for a number of reasons. There's certain banks where your checking account is a money market fund, and that's how you get a higher interest rate. Sometimes if you have a brokerage account, they will let you deposit cash, but when you deposit cash, it doesn't stay in cash. It's actually held inside of a money market fund. Maybe the money market fund can get you a higher interest rate than you could get through a high yield savings account, right? There's a number of reasons why you may or may not want to use a money market fund. But the key thing to note is that it's designed to stay at $1 and give you an interest rate. Now, is it better than a high yield savings account, a CD, or a Treasury bond? That depends on what you're trying to do. And again, I wouldn't get too worried or wrapped up about the money market fund. If you're interested in it, I'm sure there's tons of other good videos that you could find. The purpose of today's video was just really to give you a broad overview of the general types of interest rate type products that are out there. So we've got the CDs, we've got the high yield savings accounts, we've got the Treasury bills, notes, bonds, generally called Treasuries, and then of course we've got the money market fund. So I hope you found the video useful. As always, it is not financial advice, but I do appreciate you watching, and I'll see you next time.